Hey, there was a question recently. Someone asked me, how much money do I need to invest to make $100 a month? Pretty sounds simple, but when you start thinking about it in terms of how much you need to put in and how much you're going to get every month or every year, that requires a little bit of math. Let me just explain how this works, and then I'll give you the real examples of funds or income investing exchange traded funds that can enable you to get these kind of returns. However, there's nothing which is guaranteed, so this is not financial advice. So take this as a kind of a concept or a learning exercise. So let's first get started. What we are looking at is $100 a month, and this would be $1,200 a year. 100 multiplied by 12, that would be 1,200 per year. So mostly the yields are calculated per year to give you the real picture of how much returns you can get per year on any kind of investment. If you probably invest in bonds, you might be getting something like 1% a year or 2% a year, depending on the country or depending on the kind of bonds that you're investing in. Now, going with this number, 1,200 per year, like imagine that there is an investment which gives you a certain amount of yield. So based on the yield that you are getting from that investment, you can calculate how much you need to put in. There is a small disclaimer that I would like to say here. We are talking only about the income or the dividend or distribution part of the returns. We are not talking about the capital appreciation. For example, if you invest in stocks, you get some kind of dividend every quarter. However, the stock price or the value also moves up. So we are not talking about the capital appreciation part of it. We are only talking about the dividend yield part of the investment equation. So that's the point you need to keep in mind. So let's assume that the dividend yield or distribution yield is 5%. Okay, 5% is the yield that you're getting on that investment. So how much capital you will need to get 1,200 per year? So I'll ask Mr. Math. So 5% is the yield, 1,200 divided by 5%. How much that is? So you would require $24,000 to get 1,200 with a 5% yield. So with this yield, you're going to need 24K. Okay, now let's change the scenario. Let's say you invest in something that provides double-digit yields, for example, with income funds or covered call funds or other types of, leveraged income funds. You might get more amount of yield. So in that case, let's say you invest in something that provides you 10% yield. In that case, you're going to need how much to get 1,200 a year? You will need about $12,000. Because you're getting a higher yield, you need less amount of capital upfront to get the same result or the same dividend every year and every month. Like every year you will get 1,200 and every month it's $100, that you're earning. So as you move up and get a higher yield, your input or the investment that you need to put in is quite less. Theoretically, if you go on increasing your yield, you can do minimum investment. However, when you increase the yield, you are also increasing the amount of risk, uncertainty, and probably that yield may not be sustainable. So when you have something like a 10% yield, it's sustainable. So over a long period of time, S&P 500 has given 10%, 11% every year, around that range. So this is something like sustainable. However, higher yield, you might get a possibility of getting more income quicker. So that's something which is attractive, and you can go up to a point to take that kind of risk or certain kind of leverage. And if you're able to do that, let's say you go up to 15%. So I'm giving you the different scenarios so that you will get an overall idea, and then when I go to the real examples, it would make a lot of sense for you. So with a 15% yield, Mr. Math, how much would be required to get 1,200 a year? 8K? Okay, so she says you will just require $8,000. 8K. You put in $8,000 and you get 1,200 a year. If you are able to manage to get 15% yield. and in today's time 15% yield is possible, and it may not be guaranteed. Like, it's not, whatever I'm saying here is just an example. These could change depending on the type of product or type of fund you're investing in. So this is how the scenario looks like. Let's say you're even willing to go one step higher. You want to invest in something like a high yield funds or zero DTE covered calls. There are new products coming up which are giving you higher yields. And if you are able to do that, like, you can reach up to 20%. And let's say 20% as an example. You are going to need how much? So 1200 a year, and 20% is the yield. Okay. Okay. So that would be $6,000. $6,000 is required if you are going to get a yield of 20% to achieve the 1200 per year, income target. So these are different scenarios. Let's say your yield is somewhere between these two, like your yield is 18%. So you can do your math. Somewhere you will be needing around, $10,000 or around that number roughly to achieve this kind of yield. So you can do your own math or calculation. You just have to divide the 1200 by the yield number, like whatever yield you have, like let's say 10%. You do this calculation and you get the investment required. I will also show you some examples of funds and the real yields. These are just examples. Like, I have taken round numbers just for easier understanding. But I will give you some examples of real funds, show the yields of those funds in the last 12 months, historical yields. However, in future this can change. And based on the historical yields, we'll try to figure out how much money you need to invest. If the same historical performance is repeated in the future or is sustainable in the future, how much you need to put in to get 1200 per year, and how you can get to that 100 per month mark pretty quickly. I can tell you that. And depending on the fund that you're investing in, imagine you're choosing just one fund. So you will need certain amount of capital to achieve that. And how quickly you can do that depends on the fund, depends on the yield that you're getting. So stay tuned till the end to watch and know how much you can earn from income investing and achieve 100 per month target. Thank you.
Yeah, welcome back to the second segment. In the first segment, we saw how to find out how much capital will be required to earn $100 a month in passive income. And the key factor there was the amount of dividend yield that you're getting. And depending on the yield, the capital requirement goes up or down. So the higher the yield, the lower will be the capital required to achieve, $100 a month. Now that you have the framework or the idea in mind, now we are going to look at real examples and historical performance of other funds to see which funds are able to give a certain amount of yield and how much capital you need to invest in those funds to get a certain level of passive income, let's say 1200 a year or 100 a month. That's part one. The other part that we are going to discuss is the question, what if I cannot put in the upfront capital? Like, what if I don't have the savings or money to get started? What's the solution for me? So watch till the end to figure out the way I'm going to discuss that. So let's get started. So before I go ahead, just want to tell you that what we are discussing here is for learning purpose. It's not a financial advice, and it's just for understanding different examples and illustrations. So before you apply that, just do your own research and also consult with your tax or financial advisor. Okay. Before we go to those examples, I just wanted to importance of goal setting is what I want to emphasize. See, basically, you want to have a target, a goal, so that you have a certain purpose. So it helps you define a purpose. Like, for example, you need to save money for any emergency, vacation, or you want to invest in special type of training, or you want to save for retirement, etc. Second, the point that everyone needs some form of passive income. You know, if you think no, go back and rethink yourself. Like when was the last time you were, you know, able to afford everything you want, like whatever you thought, whatever you dreamed of, you can get everything. If that's the case, then you don't need passive income. If you can get what you want at any time, any place, any price, you don't have an issue. If that's the case, you don't need a passive income. Unfortunately, every one of us, rich, poor, wherever, whichever category you are, some form of passive income is required for various reasons, and some of them are pretty obvious: to cover inflation or additional expenses, special occasions, weddings, trips abroad, retirement, etc., etc., or sometimes to plan for education or skill enhancement for yourself or your kids, or sometimes you may have some family needs or expenses that need to be taken care, or someone in the family needs, support for their, you know, it could be education, or they need support to travel somewhere, or they need support to take care of themselves, or they are still at school, or they need to, get physical plus financial support. There are different needs. Different people have different needs. So depending on that, you need that passive income. Okay, there is another point I wanted to discuss here. There is a myth here that some people say, the financial advisors, gurus, and some of the experts, they say that for people who are young, you don't need passive income, you don't need any kind of income, because you can invest all your money and you can grow, So given the same logic, people think like this, like, oh, I'm young, I can live without passive income. Now, I will invest after I make the next career move. So some of them, what they think is like, they think that now since they're young and they don't have sufficient amount of savings, they don't need that so-called passive income. So they can improve their income, and they once they make a certain amount of money, they can make the next move, career move. And then once they make the next career move, they get the bigger salary, bigger savings. They can start investing or they can open a brokerage account. This is actually kind of postponing your plans. So whether it's a vacation, whether it's any other plan in your life, do you simply postpone it forever? Like you might do it for one time or two times, but beyond a point, you still need that break. You still need to go on a vacation. You still need to spend time with your family. You still need to pursue your hobbies. You still need some time for yourself. It could be for spiritual health or personal space, or it could be you want to travel, or you want to pursue some hobby, or you want to hang out with your friends, or you want to go on a traveling, you know, um, you know, experiment, or you want to go abroad, etc. What a lot of reasons. Now comes the quote from the world's most respected investor. He says, "If you don't find a way to money, if you don't find a way to make money while you sleep, you will work until you die." So that's the hard message that he's trying to knock on to a lot of people. You have to find a money. Sorry, I'm sorry. You have to find a way to make money while you sleep, which means that you have to find a way to make that passive income. Passive income is not some kind of a magic or a miracle that happened to you. Like it's basically something where you put in some effort or some kind of an investment upfront. And what happens is after a point of time, you don't have to put in more effort or more investment. And the income comes automatically or passively. So the word passive means you're putting little or no effort and you're getting a regular stream of income. So that's how it works. And the best time to start was yesterday. Like if you wanted to create any passive income, the best time to start is anytime you're ready to start. Anytime you make that first dollar of income, start. The good time to start was today. And if you missed both opportunities, well, start now. So that's my simple message. Like I'm not saying invest $1,000 or invest $50 a month, or $500 a month and whatnot. Like people give lots of different advice. You make your own plan. Like whether you have $100 a month you contribute, or you have $100 a week, or you want to do like $500 a month. It's up to you. The thing is, you need to get started somewhere, or you want to do it in a ad hoc fashion. Like you save money here and invest a little bit here, and then after a few months you get some kind of extra savings and put it there. Hey, It's your plan. You make your own plan, you make your own decisions. That's how you will, you know, get better in life. And apart from the motivational aspects in this slide, like I want to just emphasize that if you want to get that success or that level of income, like something like $1,000 a month or higher than that, that which makes sense, like which makes meaningful difference in your life. If I say $100 a month, it's not going to move a needle for a lot of people. I know that a lot of people watching this with six-figure income or salaries may be thinking, what am I saying this? I'm just telling you this 100 a month as a small illustration. It could be 100 a month, it could be 1000 a month, it could be 100K a month. It can, the math is the same. Like whether you start with a small model with the small numbers or you multiply that by 10x or 100x, the model remains the same. You have to plant the seeds today to make your own garden. Probably you will make your own garden in 1 or 2 years. So when you do that, you learn the art of investing. I'm just explaining the quote here. You learn the art of investing and grow further to become an orchard owner. So when you plant the seeds and you start growing small plants here and there, you start making that small garden and you learn the art of investing and grow further. Now beyond that garden, now you want to make something like a more commercial producing enterprise, which is like an orchard. You are now growing fruits, probably some vegetables, probably some flowers. You are now an orchard owner, which means you are a small business owner. Okay, instead of doing a side hustle and instead of working for someone or trying to hunt for business, now you have your own shop, you have your own setup, and you're sitting there and you are getting business. You are still working hard, you are still serving your customers, but the business is coming to you. I call it a kind of passive income, but still you need to work for it. You are now an orchard owner. Like you have a portfolio that is generating a good amount of income. It's generating you probably like 300, $400 a month. That's the stage you want to reach. $100 a month is a starting point. You will soon reach 300, $400 a month. That's exactly what I want you to achieve. That's why this video is all about. And if you continue like this, like if you go on the same pace, like you reached $400 a month and you keep improving, and so on, you reach a point where you already are making $1,000 a month, $2,000 a month. It after that point, even if you don't invest so much into the fund, you don't contribute much, the fund itself is generating so much of income that you can reinvest those incomes and keep growing fast. It's just like a snowballing effect, and it's like a power of compounding that takes over. If you're lucky enough, you also have savings and you also are growing by reinvesting. So you can add additional contributions, plus your dividends are also pouring in, which can be reinvested. So you are actually, you know, investing in two ways: extra savings plus also your dividend reinvestment, which is working for you. So your money is working for you in two ways, not just one way. So your investment is creating two streams of income, which are actually two forms of income. One is your fresh investments. The other one will be your reinvestment of dividends, which is producing more dividends and more, and so on and so forth. And a lot of you, many of you have learned about this compound interest and the power of compounding, interest on interest in your high school or in your, math classes. Like it's the same thing. And at that point, you are actually a plantation owner. You have your own business. You have such a big portfolio. Probably now you have two or three different portfolios serving different needs. That's the stage that you want to reach. And of course, we'll have more videos about this. And you can also watch my wealth creation series to get started in this area. Like if you don't get started in this area, the problem is you are not going to even get the benefits of the wealth creation principles. Okay, so let's move on to the next. Let's move on to the real numbers now. Now that we have the motivational aspects, now we know why we need to do this. We have a direction, we have a sense of purpose. How much do you put in? Like you need $1,200 a year. We already discussed this, and yield from the investment will determine like how much investment is required. And the yield is like expected that because we are now looking at a future. Like in most of the cases, we are looking at past data, and we hope that the similar performance happens in the future. Small disclaimer: It may or may not happen. The future results can vary. Okay. Okay. The income that you need is $100 a month or $1,200 a year. Yield from investment is the expected percentage that the investment yields per year. So when we talk about yields, we are talking about dividends or distributions, not capital appreciation. So let me make that clear. And investment or capital required would be the 1200 your income divided by the yield. So 1200 by whatever yield percentage, like it could be 5%, 10%, that would tell you how much capital you need upfront. Let me give you a small example. Let's say your investment yields 5%. You can do your math yourself. Look at this information, the example below. If the investment yields 5% to achieve 1200 a year, what is the capital required? You can do your math. You can use the same formula. So that would be, 1200 divided by 5%. So try doing that and see what you get. Okay, now let me reveal what I have here. So 1200 by 5%, it works out to 24,000. So $24,000 is the capital you need to make 1200 a year. How 1200 a year? Because you're getting a yield of 5%. So 24,000, do a 5% on that, multiply by 5%, you'll get 1200. So this is the simple math that you need to understand. If you understand this, like you can do this for any kind of numbers, big or small, the same concept applies. If you have a different yield, your capital investment required will be different. So let me go to the real examples. We have already seen the previous scenarios at different yields. As the yield goes higher, the investment required goes lower. So we have seen that, you all familiar with that. And now I'm going to give you real examples one by one. First one is IVV, which is the iShares Index ETF, which is the S&P Index ETF, iShares Core S&P 500 ETF. That's the name of the fund, and this fund yields, 1.4% dividend yield. So to get that 1200 per year just by investing in this fund, this is just an example. We are assuming that you're investing in this fund to get 1200 a year. Okay. So this is just an example. Like people can invest in different funds also. So, but just for this example illustration, you are investing in this fund. So the investment required is 86,331, 86.3K you need to make 1200 a year, because the index is giving you very low yield. Of course, the capital appreciation is higher, huge upfront capital required, and you can reinvest quarterly. Like when you get the dividends, you can reinvest quarterly, but it's not going to make much of a change. So that's the, you know, drawback with index ETF. Index ETF is good for growth. It's good for long-term investing. No doubt about that. I'm not trying to bash the IVV index ETF. It is perfectly fine for someone who is looking for a mix of growth plus some income. However, to achieve this kind of cash flow like 1200 per year, it is still difficult, and you need a high amount of capital to achieve this. However, there's one small exception. If you are someone who has higher amount of savings, let's say you have $100,000 of cash lying around, you know, and you have been investing in bonds or GICs, guaranteed investment certificates, and so on. Now you want something different. You have $100,000 lying around doing nothing. So in that case, you can invest in this fund. You can get growth plus that income that you require. And you're not worried about that monthly cash flow or income because you have sufficient amount of savings or you have huge amount of income. So you are more interested in investing for the long-term growth. So in that case, this works out fine. However, for our requirement to generate that cash flow that you need, this is not going to work, and you have a limited amount of capital, right? So this is not going to work for people having a limited amount of capital. So this is kind of ruled out from our equation or from our requirement. So we'll go to the next set of funds and see how much capital required for investing in those funds to achieve 1200 a year. IVVW. This is again another iShares fund, but this is a buy right fund, which is a called ETF. And if you invest in this fund, you are getting a yield of 17.5%. You can see that on the table on the right. So because the yield is much higher, the investment required is just about 6,900, like 6,876. So these are the salient features. IVVW has attractive yields, approximately $6,900 required to generate 100 a month or 1,200 a year. And this ETF is good in a way that it writes out the money calls, and these out the money calls are 1% out of the money. So which means there is a scope for capital appreciation. And this also provides a room for stability of the net asset value. So based on my calculations, like I calculated the trailing 12 months dividends divided by the price and I get that yield. So I've just put the summary of that information here. This is the price as of May 9, 2025. And whenever you look at any fund, you have to look at the last 12 months dividends to calculate the yield. That's very important because some of the funds publish certain yield which is based on the latest month dividend and they annualize it. However, you need to look at the dividends across 12 months, and sometimes dividend is low, sometimes it's high, sometimes it's okay, sometimes it's around the average. You average out all these dividends over the 12 months and you know calculate the T12 dividends and then divide it by the price to get the real dividend yield for the last 12 months. So that there you have it. You need 6,900 to get 1,200 a year. Not bad. Like I think some people can really come up with this amount if they are able to save like a few thousand bucks every month, and you can invest so much. Or you can invest every month $1,000 and just build it up. Okay. So that's IVVW for you. Now let's move to the next fund, which is SPY-I from the NEOS. NEOS S&P 500 High Income Fund. This fund has a yield of 12.8%, slightly lower than the previous one. And here you see that the investment required has gone up. Like you need 9,300. The previous one you needed about 6,900, but here it's 7,000, sorry, 9,371. So the good news is this fund has a solid yield of 12.8% and it's more sustainable at double digits compared to the previous fund. Capital required is about 9,400. The good news in this fund is it uses a call spread strategy, which is kind of unique to this fund and a few specialized funds that use the same strategy. And it works in all or most market conditions. For example, even if the market is low, high, whatever the case may be, the call spread strategy basically involves selling a call at a lower price and buying a call at a higher price, and then uh, the difference between the buy and the sell price of the call will be the locked in profit. They basically lock in the credit. So that credit call spread enables the fund to generate steady income every month. So that's a very good strategy, and it works even in any kind of market condition. Even if the market is bearish or bullish, the strategy still works because you're just trying to capture the price difference between the two different calls, like I explained. We will not get too much into the call spread strategy because that itself can be a big video or a big topic to discuss. But here you have a fund, you have a professional fund manager who is doing that for you, and you just have to invest in the ETF and then get the benefit of it. So why not look at this fund? And again, not a financial advice, but this is why this fund is pretty attractive. You need a higher amount of capital because the yield is not that high. You may need $9,400, and yeah, pretty attractive. Looks good. This is an option some people can consider, and this fund is good in terms of maintaining the capital, you know, level, or it doesn't erode the capital so much. Okay, the next fund is little interesting. This is the SPIT from Defiance. Defiance S&P 500 Income Target ETF. So this comes under the target income oriented funds. Because these are funds which give you a certain amount of income, and this is not guaranteed. Keep in mind that even though the fund says that this is kind of target that they are trying to meet, you can read in the notes of the disclaimer. They say that they they are not guaranteeing that, but they will try their best to achieve this 20% mark. And I have looked at the fund's performance. So far, they have been able to match the 20% returns, or sometimes they were able to beat the 20%. They exceeded, by providing more returns. However, around 20% is what they're going to return every year. Okay, SPYT is the fund symbol and the yield is 22.9%. So in the last 12 months, there has been a lot of volatility, a lot of uncertainty in the after the elections in the US and economic policies, tariffs, and geopolitical issues, and a lot of other things happening. And volatility in the market also contributed to this higher yield. Like there was a higher yield of 22.9%. Because of this higher yield, the investment required has become like $5,200 to get 1,200 a year. If I think about it, like I just invest $5,200 or 5240 and get 1,200 within a year, that's a wonderful option. Like, and if I can 10x that, like if I can put in $52,000, I can get $12,000 a year, which means like I'm getting 1,000 a month. So investing $52,000 roughly into the fund and getting $1,000 per month. Think about it. Tell me any other investment which is going to give you this kind of return. Like you're roughly getting like close to 1.5 or 1.7% every month. Like it's a pretty attractive yield. Even though I'm just giving you this is an approximate estimate, but still it's an attractive yield. Okay, the fund is unique because it targets 20% returns. And last 12 months they achieved 22.9%, which is like exceptional, more than expected. Usually you will get around 20%. Investment required 5240. However, I just want to just give you a disclaimer. Assuming a 20% yield, which is more sustainable, more reasonable, because next year you may get a higher or lower yield, we never know. So let's say on an average you get 20% yield on this fund. The investment required will be approximately $6,000. So you do all your calculation, different scenarios. You can put a higher yield and say that I just invest $5,000 and get 1,200 a year. The reality is that fund has to perform well and it should maintain your capital and still give you that yield. That's important because if a fund is going to erode your capital or erode your original principal and then give you that yield, then there's no point. Like you're not making money, you're losing on one end and making money on the other end. So total returns are going to be pretty less. But in this case, your NAV is stable, your principal is stable, and you're getting that 20% on top of it. So your capital is going to be stable. It's not going to go up or down. Like it's going to be stable, and you are going to get that 20% yield. I mean, subject to the fund's performance. Okay. So $6,000 can be like a benchmark that you can keep to get that $1,200 a month. There can be a few exceptions. There is an interesting fund next where you will need less than that, but $6,000 is the kind of I would say minimum mark of capital required to achieve 1,200 a year. Just keep that in mind. Okay, this is one of the most popular funds in the recent times because the fund actually does something called zero DTE covered call. So this is called the XDTE, S&P 500 zero DTE covered call, and this is a fund from the Roundhill, funds. They use the zero DTE covered call strategy, which requires writing calls on everyday basis, and this enables the fund to pay weekly dividends. And because of that, the weekly dividends, the trailing 12 months yield is about 32.4%. Okay, keep in mind 32.4% per year. Okay, so on a monthly basis, it's technically more than 2.5% every month. Keep in mind this yield is not sustainable. It can be low or high in the future. This is a new fund. It's about 1 year, more than 1 year old. It has done pretty well so far, and fund delivered this kind of return like 32.4% yield, not sustainable. So based on this, the investment required is approximately $3,700. Just with $3,700, you can make that 1,200 a year or $100 a month. So roughly $100 a month means like the fund is paying you weekly, right? So every week it's going to pay you around $25 on an average. Like if everything works out, but the dividends are going to be variable. So sometimes you may get higher dividends, sometimes low. Sometimes you may get a very low dividend. Sometimes you may get $10 dividend, sometimes $20. We never know. So based on this example, the fund is giving you so much of dividends. You put in $41.90 and you are getting $13.56 in the form of dividends. The dividends I have added up is over the last 52 weeks. 52 weeks makes 1 year. So since it's a weekly paying fund, I've added up the weekly dividends for last 52 weeks to get the yearly dividend and then divided it by the price. So I have put in two scenarios here to make it more realistic or to give you a realistic number. Imagine if the fund delivered 24% yield. In that case, you would need $5,000. Keep in mind that based on the current yield 32%, we have to put in 3,700 to get 1,200 a year. To get the same results, imagine the yield was pretty less, like let's say it's 24% compared to the 32 that we have. So capital required will be more, $5,000 to get the same results. Now, in the previous video, I told you that minimum 6,000 is the benchmark that you need to get that 1,200 a year cash flow. Second scenario is more realistic, 18% yield, which is pretty realistic, pretty achievable. 18% yield means 1.5% a month. Do your math. Tell me any other investment which gives you 1.5% a month. Drop in your comments or ideas below if you have any other fund or any other business that is giving you 1.5% a month. I would not be surprised if there is an ETF or a fund that you are talking about. However, if there is any other business or any other activity that gives you 1.5% every month, please drop in the comments below. I like to hear that. Anyway, so with that 18% yield, the capital required will be 6,667, roughly about $6,700 will get you that 1,200 cash flow with this yield. Yeah, the 32% yields may not be sustainable. However, yields about 20% is possible, but I would say use a 18% as a kind of a benchmark, which is kind of reasonable, achievable for this type of fund. Okay, the reason why this type of fund is able to give higher yield is because of one reason. That's because they write calls every day, which means that every day they are able to monetize that price difference or volatility on everyday basis. And imagine if they do that every day, and by the end of the week, like around Friday, they pay the dividends to their unit holders. So that's how this model works. So if you're not comfortable or you're not familiar with this type of options or zero DTE, I would suggest you to learn about it. You can go to the CBOE, Chicago Board Options Exchange, and learn about zero DTE options and see if that is something that interests you and if that makes sense to you. And then look at the funds websites, Roundhill Funds website. You can read about this fund and other funds in the same um, kind of strategy they use and see how it fits your plans. And you can use this as part of the portfolio. It's not the only fund that you'll use, but for the example or the illustration, we are just saying that you're going to invest in this fund to get that 1,200. So this is pretty interesting. This is much more faster, the quickest way to get to that 1,200 mark if you really want to do this. But it can have some risks, it can have some pitfalls. It has its own pros and cons. So this answers one part of the video, that what is the quickest way to do that. If you have 3,700 bucks, you just invest in this fund and then let the money take care of itself. The other point you can do to boost your returns is to reinvest back into the fund to increase your income and increase your returns. So that way, even if the dividends are low in the future, you buy more units and you acquire more income. This is a small tip that I'm giving you. Now we come to the interesting part, like choosing funds. So in the above examples, we were discussing about just choosing one fund. But in real life, we need to diversify. You don't want to be dependent on just one fund or one fund manager. To get better results, cut down risk, you can pick 2 or 3 funds. Now, you don't have to break your head on this. You can pick as per your requirements or as per your budget or how you want to design it. I will show you a historical yield comparison based on what we discussed above. And again, this is not investment advice, just random thoughts and ideas that I want to share with you. And you can use your own research, do your own research, do your own analysis, and come up with a better strategy. And if you want help in understanding this or how it works, the mechanics, probably you can book a call with me. We can discuss that and we can see how I can help you within the limited 30 minutes, window. I can help you get an idea how to get started. And it's not about finding the best, most efficient way and all that. Like you just need to get started and see what suits your path or what suits your, you know, objectives, and then go accordingly. And later you can make changes. So I can guide you on that. If you can book a call if you're interested. And these are the historical yields, like we discussed above. IVVW and SPY would have capital growth potential. Like you can see, the first one is IVVW, and the second one is the NEOS SPYI, and it defines SPY-T, and then you have the Roundhill XTT. Roundhill gives the highest yield, but that's not the reason for selecting that. And some of these lower yield ones, SPY-I and IVVW, these are pretty good because they have a strong capital stability. SPY-T is also stable in terms of capital and gives you higher returns too. So no-brainer SPY-T should be chosen. Like according to my analysis, even though I didn't personally invest in SPY-T, I would say SPY-T is definitely a no-brainer. You can easily choose that and still achieve your goals. If that is one of the options that you choose, combine one of the above. Like one of the above means IVVW and SPYI, one of them. So pick IVVW or SPYI, one of these with SPY-T. So you can do IVVW SPY-T, SPY-I and SPY-T. Fine. You can do like equally between those two. Or you want to put more in SPY-T and then, less in the other fund. And when you get the dividends you want to reallocate, you can do all permutation combinations. I've given you the idea, so you can do that. This is absolutely free, that you don't have to pay anyone to get this kind of idea. And you can design it according to your needs, like it's not cast in stone. And the option two, combine one of the above. Like you are going to pick one of the two, like IVVW or SPYI, and combine it with XDT. This is option two. Like I'm just giving you two simple options. You can do different kinds of permutations and combinations. No, there's no limit to that. But I'm giving you the second idea is I'm taking one of these kind of moderate yield funds and combining with XDT, which is a very high yield fund. XDT is going to jump around like it's too volatile, and SPY is going to be more stable. You're going to get the stable, smoothly going, smooth, you know, amount of dividends every month. So on one hand, you're getting a smooth amount of cash flow. On the other hand, you're getting like fluctuating, you know, cash flows. Now you take your pick. You have variable cash flows plus the fixed cash flows. So the variable cash flows can give you higher yield. Sometimes it can give you higher yield. It's more interesting. But the stable cash flows gives you more stability. So when the markets are down or when you're pretty concerned, like then you have that base or the stability on one hand. So it's just like picking one blue chip stock and probably you're picking one mid cap stock, right? The same logic you can apply here. And if you do IVVW plus XDTE, it's the same thing. The good news about IVVW, it's going to give you that little bit of extra capital appreciation plus a good amount of yield every month. So pick whichever combination works. I've given you two options. You can create your own combination or options of these. Plus, you have plenty of other funds. This is just an example. You can look at various other funds and look at the competitors of these funds and do your own analysis and come up with, you know, better design or better portfolio. Please share your thoughts or comments below if you like what you're seeing, and if you find this useful, please share this with your friends or anyone who may be interested in this or who are looking for, ideas on new investment opportunities. And what if you don't have the capital? Like in the beginning of the session or the video, I was talking about what if you don't have the capital? What's the solution? I'm going to tell you that here. Okay, let's say you like that 20% yield with SPY-T, and how much do you need to put in 6,000 to generate 1,200 a year? So we know this math already. I don't have to explain it. But how do you come up with the 6,000? Like That's what I'm going to come up with here. You need to come up with some amount of money every month to add up to the 6,000. Okay. So that's the logic. So I can give you two simple strategies. Strategy one, invest $500 a month for the next 12 months, and you will be able to generate 1,200 a year um, at the end of those 12 months because you already put in 6,000 over the 12 months, and all the distributions are also reinvested. So probably you will achieve this target within 12 months, like probably at the end of 11 months, or you know at, at the beginning of 12th month you will be almost there, like, but give it a year. Like some people may be wondering, oh, 1 year I need to wait to get this $100 a month. How is that going to change my life? How much are you making currently in your investments, whatever you're investing in? Think about that. Probably nothing, or probably you're making a few $20 or $30 in your savings account. So instead of doing that, why don't you invest in something that's going to give you the cash flow, not only for the next 1 year, but for several years, for a longer period of time? Not only that, you're going to get the interest on the the dividends or the distribution on the fund, but you're going to reinvest them to increase the amount of cash flow in the future. So which means that even the amount that you're receiving from the fund in the form of distribution, please reinvest that. Don't pull it out of your account. That's not the idea. We are trying to build wealth, grow your portfolio. Okay, that's strategy number one. Moving to strategy number two. If you are more um, financially savvy and you can save more, like you have a slightly higher income, you can save more, you are able to prudently save $1,000 a month. I would suggest you this pretty strongly. Like probably cut down some of your discretionary expenses, extra expenses. You're going to get into this plan for the next 4 or 5 months, 5 months to be precise. What you're going to do is put in about 1,000 a month for next 4 months, 4 months in a row, like on a continuous basis. Every month you're going to put $1,000, and then in month five you're going to put 1,100, $100 more. So which means you put in $4,000 plus another 1,100, which means $5,100 is the amount you put in, and you let it grow as such. Like every month you're getting some dividends, reinvest back into the fund, and then month two you're getting dividends, reinvest back into the fund. Month three you're getting dividends, reinvest back into the fund, and you keep doing that for 5, 6, 7, 8, 9, 10, 11, 12 months. You will quickly reach the target of 1,200 a year or $100 a month. One disclaimer here, the actual results can vary because we are assuming that the 20% yields are achievable or achieved already, or in the future it can be achieved. If the yield is a little bit lower, it could take longer. So even if the yield is, let's say, 18%, that doesn't mean you lost the battle. Like it's not the end of the world. Probably you need to wait a couple of months more to get the same target, or you need to invest a little more. Simple as that. So that's what I'm going to explain in the next slide. What if you don't hit the target? Like, so you don't plan to fail, right? Nobody, plans to fail. Same applies here. And if you made a plan and you didn't hit the goal, you are actually um, close to hitting the pot of gold, or you're close to finding gold in the mine. Like you're trying different options, different strategies, and you're close to that. You just need to wait a little more time or put in a little more capital to achieve that. Simple as that. So if your rate of return or distributions were not good enough, give it a few months, say 2 months to grow. That's it, simple. Option one solves your problem. Option two, your returns were completely off the mark. You invest a little more and make up for it. And is it risky? No, not that much risky because you're still investing in the S&P 500 index, which represents corporate America and all the blue chip companies. So you're not betting on the next electric car or the next new trend or some machine learning or artificial intelligence or some kind of science fiction. You're not doing that. So downside exists, but the probability of recovery is also pretty high. So you can still make a good amount of return on your money if you're willing to invest for the long term and if you're willing to be patient. I hope you liked the video and found it useful. And if you liked watching this video, please feel free to share this or drop in your comments or feedback or questions if you have any. Happy investing. Thank you.